Hi, welcome to the Morton Brown Family Wealth Weekly Market Update. This is the week of September 14th. I'm Katie Brown and joined today with Dennis Morton.
Hi.
We have a few things that we want to talk about today. First one, Social Security. Just touch on kind of where we stand in Social Security, where the Social Security Trust is at and what that might mean. The next thing we want to touch on is interest rates and where the Fed, what they're thinking about right now, where their mind is at right now for how long we may be where we are at. And then finally, inflation and how it's popping up in the strangest places. So to kick off, Social Security. And Dennis, what was that? What was that podcast that you pulled up?
Right. So Morningstar has a podcast called The Long View, where they interview strategists and thinkers on retirement. And this was an interview with Steve Vernon, who's a retirement expert. And he focused in on Social Security, it was a great conversation about the status of the trust fund and then taking benefits. So what did you get out of it, Katie?
Yeah, you know what? It's interesting. We spoke in our quarterly update, and one of the topics that we touched on was Social Security and really talked about the benefits of delaying Social Security income before claiming. And he really hammered that home. Even under the scenario of, the Social Security Trust is in place to help supplement Social Security benefits. And I think he did a great job laying out that trust provides about 20% of the benefits that are paid out. The other 80% comes from current workers. And we've actually run some similar scenarios here, but he said, all right, worst case scenario, if that trust is exhausted, which right now it's estimated to exhaust in about 2035 if something doesn't happen, or perhaps sooner because of this environment. If it is exhausted, we say worst case scenario, everybody's benefits go down by 20%. It still makes sense to delay, because the benefit that you could increase by delaying and capturing that, automatic 8% return from full retirement age to 70 is still large enough that even with a 20% haircut, you're in a better position than had you started early and took a discount. It was interesting to hear in those contexts, because we've run similar numbers internally and came to the same conclusion as well. So it just really helped validate where our thought process is at.
Yeah, and that 80% cushion comes from FICA taxes. I mean, it's what's collected every year. So and this is barring any action from Congress. So your worst case scenario there. I also liked how you talked about, if you feel like you're wondering how you're going to get this, that's where savings comes in. Sometimes savings is what's going to bridge you to that later date, getting to 66 or getting to 70. There was another conversation about whether you should claim early and invest the money, which he had an interesting take, because if you're going to do that, so somebody says, all right, I'm going to take it at 62 and I'm going to plow that money into my investment portfolio and I'll out earn that rate. His comment was, either you take that money and you put it all in the stock market, or it doesn't make sense, because you're going to have to get that 8% or higher return. And there's just nowhere to get that other than in the stock market. So you better be prepared to take on a lot of risk if that's your plan to out earn those gains that are effectively guaranteed, right?
Well, and I think that's the difference there. You can reach for that 8% with all the risk in the world, or reach for that 8% under a guarantee basis with no risk.
Seems pretty easy, but it's a complicated decision, but good they shine light on it.
Yeah.
So speaking of rates of return and things of that nature, we have to fill that gap somehow, and how do we do it safely as possible? The Fed came out today, it's Wednesday, the Fed came out today and announced that they're going to keep interest rates at or near zero through 2023. So the idea is the Fed is trying to get to maximum employment, which for them is around 5% unemployment, and get to around 2% inflation, but they're willing to let it run higher than 2% for a period of time, just to make sure that the economy is propped up properly. So we know we're in extraordinary times, but the Fed is saying we're going to keep extraordinary measures in place for about 3 years. So this is really some interesting stuff. The market, had a little bit of a bounce off of that, but I ran some numbers today to put that into context for people who are thinking about their Social Security timing. So how do you earn that? So take this example. If you have a $25,000 annual Social Security benefit at age 66, and then at age 70, that benefit jumps up to $33,000, so about an 8% gain over that 4-year period. So it's an $8,000 difference. 2 years ago, when interest rates were on a 10-year treasury were at about 3%, you needed $266,000 to generate $8,000 worth of income to fill that gap if you wanted to. With the 10-year interest rate right now at 0.68%, you would need over $1.1 million to generate that 8%, that $8,000 to fill that gap. So it's always been really hard to be a conservative investor in the last 10 years or so. But that's why the impact of Social Security decisions is that much more important when we have low interest rates, because there's so many fewer places that you can earn that kind of return. You just don't have the choices. So that's why we spend time on these things.
Yeah. We've talked about this before too. In this type of low interest rate environment, people still need to generate income, as you know, especially retirees that might be leaning on the portfolio to help supplement their income needs. And so that's when you start to reach outside of fixed income to fill that gap, and you might be reaching into riskier assets. So I think it will continue to be so important to always keep a check on how much risk is actually within the portfolio, and is that okay? And to continue to make sure that your safer stuff is as safe as you think it is.
Right.
That's it's just going to have to be top of mind.
It's never coming from just one place. I think that was the other thing that the podcast pointed out, is people focus on Social Security, but there's also, you are earning dividend income. You might have a pension. You might have other sources of income that are in your life. And just make sure, that's what we talk about, a total return approach. Like if you have a portfolio that's of stocks and bonds, we're not just pulling the dividends and interest, and the income off of it. We're harvesting some gains. We're taking from certain places at certain times. And that total return approach is really flexible when you get into times where there's these massive distortions.
Yeah. Now, how about the other side of the equation on low interest rates? So lending is cheap and money is cheap. So spending on the other side of that, which is part of the goal too, to pump more money into the economy. But let's talk about inflation for a minute, and where are we seeing some of those increases in prices?
Yeah, I think the numbers that came out last month, there was a Barron's article that talked about inflation popping up, saying that it was running at higher levels than expected. There was a 0.4% jump in the consumer price index in August, which is a pretty substantial move. And that was after some 0.6% jumps in the 2 months prior to that. But we saw auto prices up 5.4% in August. The consumer price index rose at a record 5.1% since May. So, inflation is something that just hasn't been around. The Fed has been trying to get inflation up to 2% for years. And now, the big fear was deflation, that suddenly prices just start to drop because demand collapses back in February and March. But things have snapped back pretty quickly, and you see these pockets of things that are coming up. But what are some other places, Katie, you think of that, like maybe seeing some inflation?
I think a couple of interesting places, because we see inflation in areas that have been impacted by COVID. So within meat, beef specifically, where there have been challenges in getting beef to market. So that's been a cause for inflation. But then on the other side, people spending more time at home and reinvesting in their home. So as we talked about, it's difficult to get a contractor to come in and do anything because they are busy.
Yeah.
Or build that patio or finish your basement or do anything else that you want to do to make your home kind of that place where you're spending more quality time. So just in the cost of living and homes themselves.
Yeah, and I think a lot of what happens with inflation is just these generational sea changes in habits that happened. Millennials always get the super focus on what they're doing and their habits and trends. But the question was, are they ever going to adopt the suburbs? And there seems to be some adoption of suburbs happening. So, and when you move to the suburbs, suddenly you need a car or two. So you get these big spikes up in automobile inflation. So there's just a lot of different trends and things that are happening where people are changing their lifestyles a lot at the same time. And that could be driving a lot.
Yeah. Interesting you bring that up, the millennials, as far as purchasing homes, because that was a conversation just in the past year or two, that question of, are they financially in a position where they will be migrating just because of school loans and everything else kind of still weighing down some debt, but of the home purchasing, of the real estate transactions that have been happening. I don't have the exact statistic on this, so I'm going to apologize, but it's something like more than a third, more than 35% of the transactions occurring right now are within the millennial generation, and that's projected to increase significantly over the next couple of years. So all of a sudden, there is kind of a mad rush for, to get outside of the cities, perhaps get a little more room to sprawl, and feeling like, okay, maybe there's some access to money here that might not have been as great before.
Right. So to bring it back to an investing perspective, inflation is one of those risks that can pop up from time to time. It's usually a slow creep. I mean, market crashes happen like that. Market run-ups can happen like that. Inflation tends to be this, erosion over time. So a couple ways to compete with it. One, you have to have assets, things that grow. So that's why it's good to own stocks in addition to bonds. And there are ways that you can just increase purchasing power just by compounding and making sure you're not drawing down too much and keeping spending. So keeping up with inflation is a risk for retirees, but it's a manageable risk, just something we haven't seen in a long time.
Yep.
So just to wrap up, Katie, what are you looking forward to this fall?
We're going apple picking this weekend. Just out on the farms and picking some fruit, getting some pumpkins, and I meant to put up our fall decorations. I haven't done that yet, so that too.
I still haven't taken down the St. Patrick's decorations. I'm still waiting for that to happen. There's still, that period is overdue. It never occurred in March, but it's so that's a little form of silent protest. No, there will be no jack-o'-lanterns until the leprechaun's happy.
Unless the kids have something to say about it. Pretty sure that choice might be taken away from you.
Exactly. I have no say. All right. Listen, thanks for joining us. Let us know if there's some topics that you'd like to hear us discuss in the future. Wish you and your families the best. Have a great rest of the week.
Take care.